Hey friends, welcome back to the channel. And in this video, we are going to continue our discussion on Peter Lynch investment strategy as per One Upon Wall Street. So till now, we have discussed how common people or local consumer have an edge over the Wall Street experts and the analysts when it's come to picking up stocks at an early stage of their development. So in this video, let's continue our discussion. So let's say you got a lead for any stock. That can be from your stockbroker, or maybe you saw some company in your neighborhood doing pretty good. Now, discovery of the stock is not the factor to consider when you are investing in stock. Research is a crucial part, and investing in a stock without research is just gambling in the stock market. So if you lose money in the market, it's not because of the ill fate, but because you didn't do proper research. So the first step when you are doing any research on any stock is to understand what is the market size of the company. So the market size of the company is going to give you a brief idea what kind of returns to expect from the company. So for example, if we consider a company, let's say Apple, so it is already a $3.4 trillion company. And the chances of it becoming 10x of what is it today, which is like $34 trillion company, is quite slim because they are already all over the world and selling their products all over the world. Where are they going to expand next? Maybe Mars, but that's not possible, I think, in the near future. So market size is one of the crucial part when we are researching our stock, because there are smaller companies with, let's say a few $1 million or 1,000 crores. So in that kind of stocks, we can say that our investments could 10x or 20x in returns, which are the multi-bagger stocks that we need to look at. So when we are building up a portfolio, we should have not just fast growers, but different kind of stocks as well. So in this video, let's classify stocks based on their growth and market size, and what are the reasons to look at when you're investing in these kind of stock. The six categories in which the company can be generalized relative to others in that industry are going to be slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds. So let's discuss about all these companies. So the first is the slow growers. So these are the companies that are growing just slightly better than the GNP of the country. So GNP is the gross national product. So when some specific industry slows down, hence the company in that industry and the stock slowdowns as well. So for example, if we have a look at the NMDC, so which is National Mineral Development Corporation. So we can see that from 2012 to 2023, which is around 11 years, the stock is just rallying at the same pace. And recently it has started to go a little bit up. So these are the companies that do not grow as fast as the other fast growers, and just a little bit than the GNP of the country. The another sign of a slow grower is that they pay dividends generously. And one of the main factors of giving dividends in general is that the company itself does not have enough ideas to expand the business. So if the company itself is not growing, neither its stock is going to be. Next, let's discuss about stalwarts. So these are the companies that are growing actually better than the slow growers, which is around 10 to 12%. And depending upon when you are buying these stocks, you can make a sizable gain. So the kind of returns to expect from these kind of companies are like 50% in 2 to 3 or 4 years. So consider companies like HDFC Bank. So we can see that we can expect a good amount of returns if we are holding it for some time, and which is like 30, 40, 50%. And these are the kind of returns to get delighted about. But one thing that these companies offer is good protection during the time of recession, because we can be sure about these companies that during recession they are not going anywhere, they are not going bankrupt, they're not going out of business, and sooner or later they are going to catch up the price that they should be at. So if we look at HDFC Bank, so the during COVID recession, the stock tanked a bit, but sooner or later, like 1 year, it just got back up to what it was trading before the recession. So these do provide returns, and these do provide protection during the time of recession. Now, the next is the fast growers. So these are the companies that you should be looking at when you're thinking of multiplying your money by, let's say, 2x, 3x, or 10x. So these are the land of multi-baggers. And these are the companies that are growing in double digit earnings, which is, let's say, 20-30%. This kind of growth that you can see in the balance sheet. And one thing to note is that recently there's been a AI hype, and the company in the AI industry are doing pretty good. It's not just the industry, but the stocks as well. And it's not necessary that the companies that are fast growers should be in the fast growing industry. So there can be companies, let's say hotel industry, which is not a fast growing industry in itself, but there can be some stocks that are doing pretty good. So let's have an example for that. And pretty good example would be Swiggy. And in the last couple of years, it's been doing pretty good, and its stock as well. So the main point, the main factor that you should be looking at when investing is how good is the balance sheet. So the only trick is to realize when to buy this stock and when it's time to sell the stock, because it is not growing as it used to be. And the only way that you can analyze that is by going through how the business works, by understanding more about the business and the balance sheet. So are they making substantial growth? They are making substantial profits, and the earnings are compounding, and these can give you the actual returns. And with small portfolio, one or two of these kind of stocks can be life changing. Let's talk about the cyclicals. So these are the stocks, as the name suggests, which goes into the cycles, and the profits, the earnings grow in cycles. So there can be some years the stock is doing pretty good, and there can be some years that when the business is not going good, hence their stock as well. So these are the stocks in which you can see cycles on a regular basis, which can be predictable and non-predictable. And for example, these stocks can be of automotive industry or chemical industry or some airline industry. So a good example would be like the Maruti stock. So the main trick when you're investing in the cyclical stocks is the timing. Entering in a bad time in the cyclical stocks and ending up in the bad phase of a cycle could lead to a huge loss. But when we are coming out of a recession, so this is the time when the cyclical stock flourishes, and the profits and earnings as well. So this is the best time when you can invest in cyclicals and can get a sizable gain. So yeah, detecting the signs of the cycles early on can give you a huge boost in your returns that you can expect from these kind of companies. So next is the turnarounds. So there are specifically 3 to 4 reasons about the turnaround stocks. So a great example for that can be Suzlon Energy, and it was, I think, on the verge of bankruptcy in around 2020, and after that, it has turned around to be a multi-bagger. So basically, it was trading. Uh, Trading, it was just a penny stock, 1 or 2 rupees, and currently it is at 60 and a high of, yeah, around 80 to 90. So this is the multi-bagger turnarounds that you can say. So the few reasons that a stock can become a turnaround is, first, it is the some kind of tragedy that has happened to the business. So that can be some kind of accident, some kind of trade deals that have not gone through correct, or some kind of government regulation that has led to the stock price rally down. Other is because of the bad management, or some poorly managed cyclicals, or some restructuring in the management, because of which these companies tanked down. And third is when we are talking about some conglomerate which is on a verge of bankruptcy, and there are certain business which are subsidiaries of those conglomerate, and when we spun off that perfectly managed businesses, that can lead to a turnaround business and can do pretty well, because rather than going down with the parent company, it can trade on its own and do pretty well as a business and the stock as well. And fourth is when there are companies that are planning to diversify the business, getting into other segments, but ends up worsening their own business, and hence the stock price goes down. So these were the few things that could lead a business to go down on a verge of bankruptcy, or maybe the stock price go down pretty low, and you as an investor has to pick up those stocks at that time to get the multi-bagger returns from these turnaround companies. So next is the asset plays. So I don't have any example for that. These are the companies that are sitting on something valuable and which was overlooked or ignored by the Wall Street experts or the analysts. And these something valuable can be anything, maybe pile of cash or real estate or some patents related to the products, or maybe drugs. So this is the place where having a local edge about the industry or the company can give you a significant boost on your returns when you invest in these companies. So consider some kind of real estate company, and you see in the neighborhood that the real estate in that particular area are boosting up, and this is overlooked by the Wall Street experts when analyzing a business. So that is the time when you should invest in that stock, because when the Wall Street get to know about this, they are going to invest a lot, and hence the price is going up. So these are the asset plays that you should be looking at, and having a local edge does benefit you a lot. Okay, so these were broadly the six categories in which you can classify a stock based on their growth and the market size. And one thing to note is that a stock is not going to stay forever in a specific category. So let's say Zomato, it is growing at a fast rate as of now, which is, let's say, 20-30% year on year growth. But at one point, it is going to become a media grower, which is Stalwart, and there can be some kind of serious issue with the business, and it can go down and can become maybe a cyclical or go bankrupt, and then pick up and can become a turnaround. So here the thing is that you should be analyzing your portfolio on a regular basis and rearrange the stocks based on their current growth, market size, the business aspects, and reanalyze the stocks and recategorize them accordingly. So that was today's video, and in the next video we are going to analyze more about the stocks. So after categorizing the stocks, we are going to fill up more details about the stock, looking at the balance sheet and their business, and then we are going to make a decision if this is a good investment or not. So that's it for today's video. See you in the next one.